So is the bottom for the stock market in for 2025? And Tom Lee thinks the answer is yes. I think the answer is a maybe. So I'm going to play an interview of Tom Lee right now. He's going to give you his perspective on the market and what he thinks is going to happen going forward. Then I'm going to interrupt him a few times throughout the video to give you my perspective on it, just to elaborate a little bit more on what Tom is saying, because it's not as simple as what Tom says for the bottom to be in right now. So let's take a look at this interview. Remember, we're all here to make money. Let's break it down. No BS, no clickbait, no fluff.
The risk reward is much better now than even before the trade war started. Fundstrat's Tom Lee is a CNBC contributor and joins us now from Miami. It's good to see you as always. How's that possible? How's the risk reward better now than then?
When we go back to February, when the market was at all-time highs, we have to keep in mind we had a lot of uncertainties ahead of us, and we weren't necessarily looking at 2026. You know, the tariff visibility is much better today than it was 3 months ago. And when we look at 2026, I think that there are things to look forward to, such as deregulation, tax cuts, and actually a Fed that's on hold now, but probably doing more cuts now in 2026.
All right, so I have to interrupt Tom there super quick just to show you two different charts right here. So the first chart shows you the federal funds effective interest rate going all the way back to 1955. The key that we want to look at right here is from 1980 to current. 1980 interest rates went all the way up to 19%. Now they're all the way down to 4.33%. So you can see a clear trend going down on the interest rates right here, and that is because inflation is going down. As inflation falls, the Fed is usually more comfortable to lower interest rates. So what does that mean for the stock market? And let's go back to 1980 on this chart right here also. And just so you know, this is the PE ratio of the S&P 500. So the PE ratio of the S&P 500 in 1980 was roughly 6.7, so absolutely very, very low on that number right there. And you can notice the trend from 6.7 all the way up to 28 right now, because inflation is much lower now versus then, and interest rates are much lower now versus then also. So as interest rates go down, meaning inflation goes down, so interest rates can go down because of that, the PE ratio usually goes up. And when the PE ratio goes up, that means that stock prices are going up. So that's why interest rates matter so much and inflation matters so much also.
Companies survived, I think, a black swan event. You know, that waterfall decline in equities and the sort of the near heart attack of the economy was an environment where companies produced earnings that beat expectations. I mean, so this is the fifth stress test for businesses. I mean, when I put all that together, I think PE's probably going to be higher in 6 months than lower. And when you think about 2026 earnings having upside, I think there's still upside for stocks.
So yeah, these businesses have been through a lot in the last few weeks since Liberation Day when Trump put in these crazy amount of tariffs. But shortly after Liberation Day, we did a 90-day pause, and now we're on a pause with China too. So really the effective tariff rate across all these countries is really nothing. It's 10% because we have all these pauses in place. So the companies itself didn't really have to face too much headwinds with regards to pricing and stuff like that because the tariffs were all paused for the most part. And when you listen to the CEOs on earnings calls, most of them are not really saying it directly, but they're pretty much implying it. They're implying that these tariffs are most likely not going to be a long-term thing. It's just we're going to raise these tariffs super high, what Trump did, and we're going to use that as a negotiation tactic to try to get a better deal going forward. So most of them are expecting that tariffs are just going to be transitory. They're going to go up and then they're going to go back down, and then things are going to return to business as usual.
So, I mean, because you keep talking about 26, you're not writing off the rest of this year. We still have 7 months to go.
Yeah, we have a lot of history to make between now and year end. But keep in mind that waterfall decline in stocks also was almost a complete reset in positioning and sentiment. You know, investors were forced to liquidate when the VIX hit 60. We know a lot of institutions didn't add risk back as the market rallied. So I think the pullbacks are going to be pretty shallow because investors just are underinvested at the moment. And then when you look at sentiment, it's barely turning neutral now. So if investors have been fighting this rally, as they become more neutral or more optimistic, that's upside for stocks.
So I agree 100% with what Tom just said right there. And this is a one-year chart of the VIX, which is the volatility index. So when we had all these tariffs and Liberation Day and all that crazy stuff, the VIX index shot way up. And when the VIX shot way up, stock prices fell quite a bit and everybody was freaking out and panicking. And a lot of people that had leverage and margin in their portfolios, they then got wiped out and they were forced to close out their positions because their ratios were no longer in check. And their broker said, hey, you either need to send money to your account or you have to close out these trades because they're too risky to support in your account. So a lot of people were forced to sell at the bottom of the market, which is the worst time to sell. It's when you actually want to buy stocks because they're cheaper. But that's just how people operate in the market. They like to buy high and they like to sell low for whatever reason. So people were forced to sell low and now they're sitting on cash. So now there's a lot of uninvested cash sitting on the sidelines. Now with regards to consumer consumer sentiment, you can see we're all the way down here to pretty much an all-time low going all the way back to 1980. So when consumer sentiment is extremely low, that's actually a bullish sign because a lot of people have money on the sidelines still in the market because they want to wait for just the right time to invest their money into the market. And a lot of people fall victim to this where they say, oh, I'm going to sit on the sidelines and wait at a time that the market is still down quite a bit. And they sit on the sidelines and wait for this, quote, perfect situation to buy into the market. But unfortunately, the market is never going to feel perfect to invest. The market is always going to climb a wall of worry. It's never going to feel perfect. So the key is when everybody's freaking out, when the fear greed index is very low into the fear category, when sentiment is bad and when stocks are still cheap, that is a good time to start deploying your money. So April 8th was roughly the bottom of the market so far for 2025. And I deployed a lot of money in the bottom of the market right there. And I'm making a lot of money on this upside swing. So it's going well so far, but that doesn't mean the bottom of the market is in. We could actually go lower if something bad happens from here. But statistically speaking, it does make sense to invest at a time like April 8th when the VIX is high and everybody's freaking out. It's also a great time to sell options. You can get a lot more premium when you sell options.
I mean, Professor Jeremy Siegel, like you, has grown more bullish, pointing out, in his words, the Trump pivot on the tariffs, but he still acknowledges the fact that the tariffs are likely to remain in place. Whether it's 30 on China and 10 on everybody else, that's still somewhat regressive, is it not?
We are now in a new world of tariffs, and businesses are adjusting. I think one of the things that we're seeing is that the market is now in a position where they can start to look through some of the messy adjustments, right? We know there's been a disruption to the supply chain. I think stocks can look through that. But you're right, Scott. There is now this world where there's essentially a consumption tax in place on things that we're importing. But that doesn't mean we have to actually have the PE decline or the markets to fall. It's now just something we have to kind of manage through.
So this chart goes perfect with what Tom was talking about with the PE ratios and why he doesn't actually think it needs to fall. So the price earnings ratio is just a valuation metric to say you're paying this much for the share price, but how much profit does a company make per share? So right now the market's trading somewhere around a 21 PE ratio for the S&P 500, and then these blue lines correspond to the PE ratio that the market would be at if it went down to this level right here. So right now we're in the upper bands going from 20 to 25, somewhere in this range, so it is a little bit extended right now. But Tom is basically saying this: just because we have this negative stuff going on and there are still tariffs in place, that doesn't necessarily mean that PE ratios have to go from, say, 21 to 15. Because when things get bearish and people get very pessimistic about the market and we think the growth going forward is going to be bad, the PE ratios are going to go down because the market is essentially pricing in less future growth rates and stuff like that. So think of the PE ratio also as like a sentiment index. So as people are more optimistic about the future of the economy and the stocks and companies like that and their profit going up, the PE ratio is probably going to be higher. But if we feel like we're going to go into a massive bear market, we're going to crash and everything's going to be terrible and the companies are actually going to get smaller, then the PE ratio is going to go down to probably 15 or even lower potentially. So my take is this: we're in the upper bands of the PE ratio. I'm not saying that the market's going to crash, but I am saying that the market is a little bit expensive. And I mean, go back to 1999 and 2000, and we all know what happened in this time period where we had a dot-com crash. The PE ratio of the S&P was up near 25, and look at the future returns going forward. It honestly wasn't too much. But if you look at the returns going forward when the market's trading towards the lower band of the PE, which is right here in the bottom of the 2008 financial crisis, you could see we were down near the PE ratio of 10. Look at what the market did going forward from there. So when we're all the way up here where the market's kind of like fully priced in for future growth, it's kind of like how much better can the market get if earnings don't absolutely explode? We need earnings to continue to grow and companies to continue to grow going forward in order to support this higher valuation level that we have right now. By the way, I'm not saying we're going to crash. I'm just saying things are a little bit expensive right now. But if you have a longer term horizon, meaning you're going to keep your money in the S&P for like 5 years or longer, I think right now is a good time to buy. But if you're thinking about like buying call options and doing shorter duration plays on maybe like 6-month plays, I think you're definitely gambling unless you pick the right stocks, which there are a couple out there right now that I really, really love. So if you want to see all my trades in real time, click the link below and come into my Discord. And as a bonus for you right now, the course is free. I repeat, the course is free. The course that scaled me to millions of dollars, and hundreds of my students, they are scaling on their way to millions of dollars too right now with thousands of dollars in monthly cash flow. You join the Discord, you get the course for free, but it's not going to be like that forever, and spots are definitely going to be limited.
What about yields rising? How much of an issue potentially is that?
Well, I think Fed Chair Powell made a good point that long-term yields could be rising because of inflation volatility rather than inflation expectations going up. That's actually an opportunity for markets because if inflation volatility delivered is less than expected, then we could expect yields to come down in the future.
So Tom absolutely nailed that one because the University of Michigan just came out and they're saying that the 1-year inflation expectation is going to be 7.3%. So that is very, very high. So remember, as we talked about earlier in this video, if inflation expectations are 7.3%, that's going to imply that the Fed is going to keep interest rates higher for longer. That is very bad for the economy and the stock market because stocks don't like it when interest rates are high because bond yields will go up and then bonds are going to be more compelling versus the stock market. So people are then just going to go put their money into bonds versus in the stock market, which will then drive stock market PE ratios down. So as the stock market prices in this potential that the 1-year inflation expectation is going to be 7.3%, the market is probably going to go down a little bit as it prices that in. But as it doesn't materialize and doesn't actually get reported in data, that's going to be upside surprise in the stock market to go up because it's like, okay, we got May, we got June, we got July, we got August inflation data and it's staying around 2%. So it's not likely that 7.3% is actually going to materialize. So when the market unprices at 7.3%, the market could then go up because interest rates will be expected to then go lower.
What if finally the bond market is saying enough is enough and it's time to get real? And if you all don't, we will.
There was a moment like that a few years ago when, when an auction went badly and many people declared this was sort of the end of the ability for the U.S. government to finance, and people panicked and the VIX surged. But even in that moment, it proved to be a buying opportunity for equities. So I think if there is a moment where maybe the bond market sort of has a tantrum about that, and I'm not saying it's going to happen, but if it does, I think we have to remember the U.S. is a huge economy. There is still a lot of trust in the U.S., and I think those who've called for the end of U.S. exceptionalism, I think that's been the premature call. And if none of those is true, the bond market and investors can handle even a 4.5-4.7% 10-year.
So I'm going to keep this crystal clear and extremely simple. If you don't believe in America for the long run, you should 100% not invest in the S&P 500, don't invest in the NASDAQ, and don't buy any individual companies that are based in the United States. And if you're really going to stick to your guns on that, I urge you to go short the S&P 500 on a 10-year basis. So take all the money you have, go short all the shares of the S&P 500, and then close your eyes and forget about it, and 10 years later, you should make a lot of money. But I'm willing to bet that nobody watching this video has the balls to do that. I don't have the balls to do that. I would never bet against America in a 10-year period. So when you look at it like that, it's kind of like, what is your alternative? Are you going to short America in the long run, or are you going to invest in America in the long run? America is going to be fine, in my opinion. Be patient. All this stuff is going to blow over. There's always going to be something else to worry about. But in the long run, America works. We've been through so many bad things like COVID, 9/11, dot-com crash, great financial crisis, 1929, 1987, the Black Monday stuff. There's a lot of bad things that happen in America in the long run. But in the long run, the market usually trends up if you're patient. Individual companies can go to zero, but the S&P 500 is not going to go to zero. Be patient, keep your pants on, and I'll see you guys in the next video.